Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going on out there? It's January 31st. I'm friend Curzio, the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. In today's episode, I'm going to break down the latest earnings by tech giants Microsoft, Google, AMD, and tell you which one of these three you should avoid at all costs. Elon Musk's $55 billion pay package for Tesla just got struck down in Delaware court. I'm going to tell you why this is a really, really big deal, and every investor should pay attention to it. And I'll also share my latest thoughts on the crypto market, including why diversifying outside of Bitcoin can make you a fortune over the next 18 months. Now, let's start with earnings. Big story, Microsoft, Google, AMD, three of the most popular and most owned stocks in the world reported earnings all last night, and all three stocks are down. I guess that could be expected, given the run-up in these names over the past 2 months. Incredible run-ups. And when I look at each one of these names, it's a different story. I'm going to start with Microsoft, which I find fascinating. I find this hilarious because I cover this, and I've covered Microsoft for 20 plus years, been doing this all my life, basically. And over the past 8 quarters, if you notice, when Microsoft reports, it's almost the same exact thing. I'm not saying it's a Bernie Madoff situation. It's not. But if you look across every one of their divisions, okay, they're going to report the numbers. You're probably going to see the headlines if you cover this at home, and they beat, the number on the screen, and, it's revenue, earnings, and then, you get details about cloud and stuff like that. It's fine. But for guys like me to look under the hood, it's kind of weird when every single quarter, at least for the last 2 years, probably going back for the last 3 years, and this is like post-COVID, they barely beat on every single one of their divisions. Now, if you're generating $10 million in sales, $100 million in sales, okay, it's not a big deal. This is a company that generates over $60 billion in sales per quarter. And like clockwork, Azure Cloud Services up 28% compared to guidance of 27%. Productivity and Business Process Division, that's Office, LinkedIn, $19.2 billion versus expectations of $19 billion. Again, it's always just slightly beat across the board. Intelligent Cloud, which is, that's specifically Azure and Nuance, $25.9 billion versus $25.4 billion, which was the expectations. Then you have Personal Computing, which is Activision, Windows, Surface, Xbox, like that gaming divisions, and Windows combined, $16.9 billion compared to $16.7 billion. Every single quarter you go, it's like this barely beat on every division. I know they generate recurring revenue. They do a great job on the accounting side to push it out perfectly, so they barely beat, and it looks really cool. So you're not going to see blowouts here, blowouts there. It's like these small beats across the board, and that's great. I mean, if Google did that, it'd be even better. I'll get to that in a minute. They don't know the formula to how to report. Disney knew the formula of how to report by just saying, hey, everybody wants to see us add names, even if we add them for free. No one gives a shit if anyone's paying for streaming. They really don't give a shit. Let's just give it away for free. Hundreds of millions of people sign up, and that stock went from 80 to 180. And then people were like, wait a minute, those numbers actually matter. And it fell. Now, they're generating this revenue, but it is interesting how they barely beat. And if you look at the actual numbers altogether, they came in at 293 in earnings compared to 277, which a lot of that beat was, and sales guidance came in again just ahead. So reported sales of $60.5 billion, and this is for next quarter, but that was actually lower than $61 billion. So it's slightly lower, which was the guidance was slightly lower. But when you look at the earnings beat, and that's for the past 3 months, a lot of that could be attributed to cost cutting and buybacks. And without those, it would have been a lot closer in earnings. But now the guidance was a little light. And here's where you need to understand of how this works and what usually happens. Okay, when you have a company that has high expectations, meaning it's very expensive, trading at a very expensive valuation, and it's going up into the quarter, you better report very strong earnings, and more importantly, you better report guidance. You better raise your guidance. Now, the fact that their guidance missed on sales for next quarter, okay, missed. It's a slight miss, but it missed. It's a big deal when your company, Microsoft, is trading at 38 times forward earnings. Okay, they're in the right growth market. You can say AI, cloud, growth's there, massive recurring revenue, huge balance sheet. I get it. You don't have to try to convince me. It's a great, 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 great company. One of the best ever. I think it has a higher market cap than Apple right now. $3 trillion. But I wouldn't tell you to buy it here. Given that the company is trading right now at its most expensive valuation, get this, since 2000, over 2 decades ago. Don't have to remind you what happened back then. I'm not saying it's going to happen this time. Companies were in much worse shape. Balance sheets weren't stronger back then in 2000. But the most expensive valuation, where you're trading at that kind of valuation, you need to meet your numbers. You need to consistently report growth. And they're not. And the stock's down, and it's only down a little bit, which is surprising. I wouldn't tell you to buy it here, though. I think you're crazy to buy it at these levels, at this expensive valuation, when they're not putting up the numbers. Although that's been the playbook over the past year. We've seen earnings decline year over year outside of last quarter, started growing again very slightly. We had a year where the market, where Apple didn't grow sales or earnings for a full year and increase its market cap by $1 trillion. I mean, that's fucking crazy when you think about it. That's absolutely crazy. $1 trillion. Massive. I would say, not that I'm saying to short Microsoft. It's when I look at these companies, it's just better plays. And I look at Google, which is getting hurt more than AMD, which was terrible. I'll get to that in a minute. But this is a company trading at all-time high heading to the quarter. So the stock was pretty much, it was bound to fall heading, after reporting earnings. That usually happens. That's okay. But it's down over 5% because they slightly missed on ad sales. And to me, that's insane. So when you look at earnings, beat the earnings number, 164 compared to 159. You beat on sales, $86 billion in sales I reported for the quarter. $86 billion. I mean, you want to put it in perspective, sales to sales, earnings are different, margins are different, right? You could have, $1 trillion in sales and your margins are really tight and you're not generating a lot of money. But $86 billion in sales for the quarter is 43% higher than what Microsoft generated for their quarter. And yet, Microsoft trades at a $3 trillion valuation, and Google trades at less than a $2 trillion valuation. Not the perfect apples-to-apples comparison, but it just goes to show you, if Google gets cloud right and gets AI right and these high-margin businesses, it's going to go to a $3 trillion valuation based on when Microsoft's trading. So they beat on cloud. Search was strong. YouTube ad sales was strong, but total ad sales, again, which is the main part of their revenue, and get this, it missed. It missed the $65.5 billion estimate by 0.5%. By 0.5%. And the stock is getting nailed today. Down 6% right now as I look. Getting absolutely nailed. And remember, Google's not Microsoft trading at 38 times forward earnings. Not AMD trading at 50 times forward earnings. Who actually lowered guidance? Again, we'll get to that in a minute. It trades at just 22 times forward earnings, which is pretty much a market multiple. The market's trading at 20 times earnings, but it's growing sales over 32% annually. Earnings growing even faster, much, much faster than the overall market. And if you go last quarter, what happened? Google got hit after last quarter as well. And it wasn't because of ad sales, it was because of cloud. So cloud only grew 22% last quarter. So cloud was, you have these KPIs, key performance indicators. And they want to see cloud growth, they want to see ad sales and stuff like that. But apparently cloud was a really big deal for Google last time because ad sales was strong. Cloud wasn't. It grew 22%. They were expecting, I think, 23, 24%. The stock got hit before recovering and going to an all-time high into this quarter. If you look at cloud this quarter, it grew 26%. Easily beating estimates. But yet the stock is getting hammered because one tiny thing within ad sales. And that's why I'm saying follow the Microsoft playbook. I'm sure you could have squeezed out a little more. You have recurring revenue as well coming in, massive sales coming in from everywhere. I'm sure you could have got that number a little bit higher and pushed out sales. Again, this is, you could say it's manipulation of earnings. Every company does it. I mean, it's no coincidence. Microsoft beats on every single division just by this much every single time they report every quarter for the past 2-3 years. They're smart. To be smart. I mean, they were focusing on cloud because, hey, we just got our ass kicked last quarter because we didn't meet cloud estimates, but now you did. And now ad sales 0.5% lower. And we're not talking about, I a 0.5% on 65 billion, 0.5%, and the stock's getting nailed. So for me, I look at Google, where it's trading, and how they are in AI. Cloud is growing. They're going to be fine with search and revenue. They understand the importance of getting AI right, since it could impact their business the most, and they're doing great. You want to get a little more clarity on it. It's hard to get clarity when you generate 68 billion in sales or 86 billion in sales, and you're looking at Microsoft generating over 60 billion in sales. So cloud's not going to be a meaningful revenue generator, but it is going to save a ton of money for them in terms of productivity, in terms of efficiency, in terms of cutting costs. So you're not going to say AI generated this much money. It's not going to be significant for probably another 3 to 5 years, as big as it's going to be. It's not like NVIDIA is like the pure play here. I mean, their chips are the best. They're getting revenue directly, right? So they get revenue first, and then everybody else uses those chips, and then they're going to build software systems and use GPUs and to grow whatever they're building. So when I look at Google here on this pullback, I think it's a screaming buy. I mean, cloud growing, which is huge. Massive amount of data, so AI, they're going to be one of the biggest players in AI, along with Microsoft, along with Amazon, on the software side of this thing. But I think it's a screaming buy here. 22. It's a big 22 times forward earnings compared to 38 times forward earnings with Microsoft, which is crazy. And they lowered their guidance. Now, AMD, on the other hand, this is a pretty crazy stock when I look at AMD. I mean, people are saying it should be included as a MAG stock. We heard that in Davos. And the stock just started running. Nobody cared. It just running, right? Oh, they got to catch up to NVIDIA. They're not even, they're not even in the same vicinity. Not even close. I mean, they're like in China and NVIDIA's the U.S. I mean, they're not even like near NVIDIA. Okay, they're number 2 in the market, but they're number 2 like Wendy's is number 2 compared to McDonald's when you're looking at what stock you want to buy. Okay, it's like all right, what sneaker are you going to buy? All right, Nike makes the best sneakers, Reebok's second. Or maybe whoever is second. Puma, whoever is second. You don't even care who's second because it doesn't matter who's second. That's how far second they are. And this is a company that ran up tremendously, and they don't have the earnings support. So it's trading at 50 times forward earnings. Forward earnings getting into the quarter. You know how high that is? Again, the average S&P 500 company is trading at 20 times earnings. 2.5 times the market. So 50 times, it doesn't mean you're expensive if you are growing your stock and growing earnings and sales like gangbusters. That's fine. And I've learned that lesson the hard way through not owning Netflix when it traded at 120 times forward earnings 10, 15 years ago. Microsoft traded at that valuation. Apple traded, all these during their early stage growth traded at massive valuations, and people avoid them because I got to buy a PE that's lower than the market. No, it's about price to earnings growth. How much are you growing? So if you're trading at a premium to the market, which growth stocks dominated the market the past, since the credit crisis pretty much. Growth. Value sucks. Growth. That's fine at 50 times if you're growing. But they're not. They reported inline earnings and sales for the quarter, which is fine. You want to look at the guidance, but they lowered their guidance. Their margins are flat at 51%, meaning that they don't have pricing power, yet NVIDIA could charge whatever they want for these freaking chips because you have the biggest companies in the world with the biggest balance sheets dying to get that edge in AI, buying those chips, what are they, 40 grand each? Buying 10, 12 per system and building it and buying hundreds of systems, spending billions on it. They have pricing power. Right now, AMD doesn't have pricing power because they don't have great AI chips. They have secondary chips for people that are like, hey, I want to get into AI. It sounds like a good thing to do. It's like the Bitcoin miners. It's like you talk about the biggest miners in the world that have all these operations, and you have a little kid in his basement saying, oh, I got, a new graphics card that's pretty fast. I'm going to try to mine for Bitcoin or mine for whatever cryptocurrency. It's a big difference. And you're looking and say, why are results so weak? Because AMD, unlike what you're told, is not a pure play on AI. It's not like NVIDIA is pretty much the pure play on AI. And the gaming systems, but still, those chips are used for everything. Across the board. Even for crypto miners. Especially with the halving coming. To make it harder, you need faster chips, which means a lot of these miners are probably going to go out of business because they can't afford the chips. And now you're going to get half the reward with the Bitcoin halving coming up in April. Anyway, get to that more in a minute. But when I look at AMD and the whole entire company, gaming is a big portion of it, down 17%. They call this segment, it's called embedded, which is industrials, PCs, down 24%. So you're seeing growth within that AI portion of the business, but these are big segments for AMD, which are getting destroyed. So you're going to see sales come down as they transition this business. You're going to see earnings come down as they transition this business. But for the stock to be trading at 50 times forward earnings, you need to see this thing growing, and it's not. And the fact that the stock's only down 3% any other time outside the past 2 years, because the market's all wonky with the government spending trillions, AMD or any stock trading at 50 times forward earnings at lowered guidance would be down 15% that day. And it's down 3%. So my question for AMD bulls, if you own this stock and you're like, hey, I love AMD, why would you own AMD at 50 times forward earnings and growing at 10% when you could own NVIDIA trading at a 30% discount to AMD, growing 3 times faster, and is the pure play, premier AI company in the world? And that's how you have to look at investing. I mean, you look at it that way, it makes sense. It's not that I don't want to buy Disney. I just think Google trading much cheaper than Disney. You have the AI component. You have the media component. You know, why own Disney when it's not even, it's not even a growth stock? It's a cost-cutting story. I don't know why the hell they reinstated some of their dividend. What is it? Why pay a 1% dividend? I have no idea what management is doing. Use that money for content. Use that money for anything for Disney. Why would you do that? I have no idea. No idea. Let me pay 1% dividend when I can get 4% for free in a bank. Why? Just shows you where Disney is right now. But you're owning the number 2 player in this space. Everybody's hyping this thing up like it's the greatest thing ever, and it's not. It's not. And it could go higher. I'm just saying if this goes higher, NVIDIA is going to go significantly much more higher. And I think the downside risk here, what you're seeing in terms of growth, in terms of margins not increasing, you're in AI. You should be able to, if your chips are that great, your margins should be exploding here. Exploding. I know your margins are shitty for PCs and stuff like that, but they should be exploding here like they are for NVIDIA, where they have unlimited pricing power right now because they have the greatest chips and people need them if you want to get that edge in AI, which is critical right now at this stage. But to me, looking at AMD, I have no idea why you own it. It's not gonna get bought. It's not gonna get taken over by anybody. It's way too expensive. He's gonna pay premium for this stock at 50 times forward earnings, especially when you have 2 divisions that are terrible. No, absolutely not. So probably going to cut costs pretty soon. Probably going to lay off employees. They got to get those earnings up somehow because you're not going to be able to maintain this valuation. So CEO on TV today, she's great. But the bottom line is you missed your numbers. You lower guidance. It's not good for AMD. Be careful owning this stock. I know it's a fan favorite. I know when you go on TV, everybody loves AMD. It's a great. This stock has run up tremendously, and it doesn't have the numbers behind them like NVIDIA. And moving on, because we're going to get lots more earnings, and Daniel and I love covering these things in detail and giving you ideas and stuff like that and how to invest and which we do in the Dollar Stock Club portfolio for Wall Street Unplugged Premium. We host every Thursdays on fire, doing great, especially the last few picks, last 10, 12 picks. But I want to move on to very important news. It's Elon Musk is in the news like every day, given that the left media hates this guy, even though he's done more for climate change than any individual on the planet, which he pointed out, which is true. They just hate him. But Tesla's board of directors approved an incentive-based package for Elon Musk in 2018. If he hit these incentives, it would reward him $56 billion. Holy shit, the guy's going to get paid $56 billion. That's insane. That's insane. How could you pay anyone $56 billion? That's crazy. Well, it's not really too crazy, because his board approved this, and everybody was for it because in 2018, the stock was at 20. And he said, if I get this stock to 100 to 150, these incentives come in, and as a shareholder, and even everyone at the board of directors, who usually have share-based incentive packages as well, are automatically going to approve this because the stock's going to go to 150. That's great. Everybody makes out. And he said, if this happens, hey, I invested throughout the company every single time we raise money. You said it was going to go bankrupt. He writes the biggest check in almost every time they financed over the past 6, 7 years. And he said, well, if I do this, this is how much I'm going to make. And he did it. The stock was in the low 20s. It went to 300. It's still trading, around $200 a share. But a Delaware judge came out and voided this package. And of course, left media is loving this. If you go and look for it in stories, all writing about it, right? Hundreds of stories mocking him across all the major media platforms, which is expected. But guys, this is a big deal. First, if you look at Delaware, it's the most business-friendly state. It's where a lot of companies incorporate. We're incorporated in Delaware. I mean, so much so that 60% of the S&P 500 companies are incorporated in Delaware because of how favorable they are to businesses. Delaware, the little tiny Delaware. And now you do this. Be careful, Delaware. Because if I'm a corporation right now, and most of these companies and CEOs have incentive-based packages, if I know that I meet those incentives and you're going to strike me down and say I can't get paid in a court of law, my board of directors approve this, no matter what the amount is, they're not going to incorporate in Delaware anymore. And that's a major, major, major source of revenue for that state. And the fact that you were able to do this in a court of law, when again, this is approved. And we have our security token that trades on T0. Gives you a direct equity stake in our company. Trading at around 2. So if I said, hey, I have all these incentive things and everything, if this thing goes to 50, I'm going to make a $50 million paycheck. Would you approve that? Of course you would. At 50, if you're an owner and it's 2? Absolutely. Because 1, I'm like, holy shit, if it goes to 20, I mean, the guy's not going to get paid. It goes to 30, he's not going to get paid. But this is a really big deal. Like, if you look at CEOs, who a lot of these CEOs structure the package this way, I mean, are you not going to get paid after you gave your life and your services to everything and you did everything you can? You took time away from your family. You met these goals. So you can't look at it as $56 billion. Why does he need $56 billion? You're absolutely crazy. This is set. This is what he was going to make if he met these goals. And he turned this into a $1 trillion company, which is now $600 billion. And he wants to be a 25% owner. Now, when I look at this, because there's a company I'm going to give away, a lot of you probably know it, especially if you're subscribers. And it's called Wrap Technologies. Okay, this is stock, rode all the way up, came down, and then when it was at $1.50, $1.75, pounded the table so much so that I have $750,000 in it, roughly. Been buying it at these levels as well. Why? Because I think it's a $20, $30, $40 stock, and it has the potential to get there. I don't say that, but if it doesn't, I could tell you, if you're like, Frank, you're full of shit, well, I'm probably going to lose a lot more money than anybody else who buys this stock. I know the story very well. It used to be a great story, and now it's not just a story. Now you see revenue start pouring in. I covered Taser. It's similar to that. It's a wrapping device. Again, give it away because I've been pounding the table the last 3-4 months, telling everybody to buy the crap out of this thing under 2, under 250, 275, and it's about 350 now. I think earnings are going to absolutely soar. And there's only one competitor in the industry, which is Axon, and they traded 13 times sales. And if this company, you put a multiple on that, I think they could do $100 million in revenue over the next 12 months. After doing $8 million, $12 million. In this last quarter, they just got a record order, their largest order in the company's history, $5 million, just one order. And I think a ton of these orders are going to come in because they're in close to 1,500 law enforcement agencies now. So it's not just a story or a concept of, oh, this device might make it on the belt. It's there. Now they took over cameras. Now they're going to have data storage, just like Axon, which gets 90% margins. And, again, no other competitors are really in this industry. Well, Axon has a monopoly. These guys captured 10, 15% of the market. It's huge. Now, when we go to Scott Cohen, he just took over the CEO role. And Scott Cohen's a friend. I've interviewed him on this podcast. Again, if I'm giving this away, don't get mad because you guys should have been pounding the table under $2. Now, he became CEO, which is a lot different from executive chairman. Okay, it means your whole life, you give up your whole life, operations or employees, everybody reports to you. Okay, executive chairman is 10% the job of the CEO. You're busy, you're in the board of directors, it's fine, but it's hands-off. Let me look at the numbers, and you could point different directions. The CEO is very, very hands-on, going across the country, meeting people, everything, right? Now, he did, in his pay package, he just became CEO a couple weeks ago, and I said, this is massive because I looked at the pay package. He's not receiving a dime. He's not getting paid any more money, even though it's going to take a considerable amount of time. And he's doing this as someone who invests in lots of companies and put these together Kind of like Anderson Horowitz, Peter Thiel. They don't take the CEO job. He's taking the CEO because that's how big of this opportunity it is. And his pay package includes, I think it's 600,000 options. And they're only going to invest if Wrap goes to $1 billion valuation. And it's $350 now. And in order for that to happen, it has to go to $20 a share and stay over $20 a share for 60 straight days. He's going to get a nice pay package. I'm for that. I'm a big owner in the stock. I would love to see it go to 20. That's a lot of freaking money I'm going to make. I'm not going to get mad that he's getting a big pay package because he's putting all the effort into driving the stock towards those goals. That's why I love Wrap. That's why I love that. And that decision just came out recently. I love the fact that he's there. He's going to be there long term, and he's incentivized to drive this thing to over $20 a share. By the way, if things go right, I think it could be triple that now. That's why it's one of my largest positions. Again, do your own research. Don't just go in blindly, and it is a small cap stock, but that's how I feel. It's my largest position. So when you structure these deals, it's really important, guys, because the way this went down, where out of nowhere, right, this was struck down, but struck down by Delaware in a Delaware court to the point where I guess I'm going to incorporate someplace else. To me, this is a big overstep, but it could result in a lot of the S&P 500 companies saying, hey, you know what? If you CEO that has most of them have incentivized pay packages, and say it could be 20 million, 50 million, 100 million, like that's a lot of money. But if the stock's up 30, 40% 3 years in a row, they deserve that. That's the package, and it's best for everyone. So it's not like, oh, you're paying this guy for doing nothing. That shit, the golden parachutes and shit, when you leave a company and you get paid massively. I mean, who's the idiot who left J.C. Penney and got paid a fortune and you know, destroyed that company? Where'd he go? To Home Depot or Lowe's, wherever. Lowe's, I think it was. I mean, that's horrible. Remember, Mullally turned around Ford, had a massive pay package, turned around a company that looked like it was going bankrupt in a credit crisis. But that stuff's approved by the board, the shareholders, and that makes sense. But now that you achieve that and the stock goes up, people are gonna complain and bitch about it. Forget about the media, the people that don't own shares. But as a shareholder, that's what you want. I don't want to pay this guy $100 million over 4 years and the stock does nothing. F you. I'd rather pay you 3 times that amount and the stock's gonna triple, and everybody gets paid. Everybody's happy. That's great. All the incentives are aligned. But the fact that Tesla is down on this news is telling. Because it should be good news, right? You're saving, $56 billion, holy cow. But it means that shareholders, most loyal people of Elon Musk, are worried that he may take a lesser role at the company or not be as involved going forward. Pay close attention to this story. I don't know if it's going to get reversed or not, but Delaware. If Delaware was a stock, I'd short the shit out of it right now after this decision. Because those 60% of those companies, S&P 500, I mean, all of them, almost every single one of them, the people in those boards, the CEOs, they have pay packages structured to these incentives and these goals, and most are tied to the stock price. And if you meet those and you're not going to get paid, man, you better incorporate someplace else. This is a great opportunity for other states to jump in and say, hey, you know what, get a ton of the business. Because Delaware just went from one of the friendliest states to incorporate to one of the worst states to incorporate after this decision. And it's going to have massive, massive effects going forward. Trust me on that. The last but not least is crypto. So Bitcoin, Ethereum catching a bid after falling following ETF approval news. I love Peter Schiff. I told you Bitcoin. I mean, he said Bitcoin's going to zero forever. Buy gold for the last 15 years and every single asset. You could have bought a rock and it'd be worth more than gold. A rock that doesn't have any minerals in it, and you probably sell it for more, make more percentage-wise than what gold went up in the past, since 2013, 14 when it hit the top? I feel like it's been trading at 1,900 to 2,000 and back and forth for at least 3-4 years, it feels like, right? But all the bears came out and said, oh, the ETF's not a big deal. Listen, we held an event. We told you about this. We said, look, the catalysts for Bitcoin have never been greater. And it's the ETF approvals. It's going to bring billions and billions of constant flows into the market. And then you have the Bitcoin halving coming, which happens every 4 years. They reduce supply growth in half, which automatically results in Bitcoin, well, the price moving higher, right? If you lower supply and just keep demand the same, it's going to go higher. But you're not keeping demand the same because you have this massive demand coming in for the first time of billions of dollars going into these ETFs that are buying Bitcoin. So after the ETF approval, we said it's probably going to come off a little bit, and it did. But it's going to be one of the greatest buying opportunities because it's not just the ETFs. That's just one of many, many, many catalysts. Okay, because now you turn this industry, which used to be cyclical, into a secular growing industry with this money constantly coming in for years and decades to come. Because it's here, funds want it. More importantly, the funds want it because people want it. They want to invest. That's their goal right now, especially if you're under 40. Every reason to buy gold, you worry, central banking, spending like crazy, safe it, whatever. It's Bitcoin. People going into Bitcoin. Now, we all know, or you should know, that Bitcoin does very well into the halving, which occurs every 4 years. It does well into it, and also does well for about 18 months after. But we also had this sell-off because you see demand's not really there after 2 years, and then it comes down into the next halving, right? So you see, this constant up and down, cyclical market. Now you have this demand coming in where you're going to see constant demand over the next 4 years. So the next Bitcoin halving is in April, just a couple months away. And the last time this happened, May 2020, I think May 11, 2020 to be exact, Bitcoin surged 640% over the next 18 months following the halving. So, great news. You want to own Bitcoin. But like I said earlier, with AMD and NVIDIA, and like I say all the time, it's not just I'm telling you I wouldn't buy Disney, get rid of Disney. It's that there's much better place than Disney here. Now, Bitcoin does well, and you hear that everywhere. But what you might have not known is that if you look at the crypto market in terms of total market cap and you strip out Bitcoin, it went up over 2,000% over the same time frame in 18 months compared to 645% for Bitcoin. So nearly 3 to 1, the rest of the crypto market went up. And people don't talk about that. They're like, Bitcoin halving, got to own Bitcoin. I get it. Okay, this is the huge opportunity. When you look at cryptos, don't think about them being shit coins. They're software companies. But now that you're seeing the money pour in, now that you're seeing the regulation, all affairs, FTX and all this garbage have failed, all this garbage removed from the industry, now you're going to see the innovation come. And it's some of the most incredible innovation because it's disrupting the biggest boys club in the world, which is the financial sector. And that's exciting. All these bullshit fees you pay, all the banks bail out anyone they want. They could take on as many risks as we saw in credit crisis and destroy people. Nobody goes to jail ever. All this bullshit. That's how Bitcoin was launched anyway, right? 2008. Why? Credit crisis. All the bullshit, avoid central banks, all this crap. But now you're seeing innovation. You're seeing great, great companies. A lot of these names are in our portfolio, Crypto Intelligent portfolio now. So when you see the halving coming too much, you're going to see tons of headlines, but they're only going to be mentioning Bitcoin. But you look under the hood, you're better off owning a lot of great names or having exposure to these names. It's a risky sector, don't get me wrong. I'm not telling you to sell Bitcoin. Okay, I own Bitcoin. I'm not going to sell it. But imagine instead of generating 645% returns on Bitcoin, 18 months, the halving, you could have generated over 2,000% on Ethereum, 4,000% on Binance, 8,000% on Polygon. Notice that you heard a lot of these names. That's why I pulled them. I'm just cherry picking here or there. These are names that you know. Dogecoin, 10,000%. Solana up over 13,000%. Axie Infinity up 24,000%. Where could you possibly see those gains in the stock market? Please tell me. I've been doing this for 30 years, especially now. You might have been able to do it 10, 15 years ago, buying some of these big technologies really early on. Now it's almost impossible because they come out IPO at stupid valuations. And if things work out, you'll see 300-400% gains. Good for you. Almost every single SPAC has gotten annihilated because they came out at crazy valuations. Insiders cashed out $22 billion. They cashed out of these companies. They told you, well, great companies, buy them, hold them long term. Well, you got fucking annihilated. And now, Gary Gensler, SEC, what a great man. Now you're going to provide regulations. Finally, on SPACs, when nobody's launching them and nobody cares after Wall Street's out of them. You wonder why Bitcoin and crypto is a big deal. This is why. These are the returns that you could generate. So next wave of cryptos, again, don't look at them as shit coins. Some of them are, but these are software companies. Innovations, they're coming. Many of these names we found, Crypto Intelligence Portfolio, like I just mentioned, and they're doing well. It's been on fire the past 4 or 5 months. Before that, we know crypto has been terrible. FTX, Celsius, a lot of this shit. But 4 months ago, I was selling this newsletter and said, buy it because you could buy the best names and generate massive returns. Just like in 2008, 2009, the bottom of that market, over 20% of the S&P 500, roughly 20%, was trading under $10 a share. I don't know if you'll find any company in S&P 500 trading under that. Maybe a couple. Now, I held a live event, and this was in December. I highlighted the massive catalyst coming for Bitcoin and crypto, the Bitcoin ETF approvals and stuff like that, but also said, look, buy now. You're probably going to see a short-term pullback in Bitcoin after the ETF approvals, right? Sell the news event like we see in stocks. Many of you attended that event, and it's for absolutely free, right? You attend the event, and I couldn't believe how long you stayed on. I think we held it for 2 hours, only because an hour and 15 minutes of that was Q&A, and it was live. It wasn't like, hey, it's a live event. It's a PowerPoint with me talking in the background. It's live. If I drop coffee on me, make fun of me. Go into the chat. Have fun with it. And got a great turnout. I couldn't believe how many people stayed. And just asking questions about crypto. It was awesome. Again, free event. So next Thursday, I'm going to hold another live event, Crypto 2024. It's not going to be 100% about Bitcoin. It's going to be about showing you how to position yourself to potentially make enormous gains. 5,000, 10,000% gains that I would never say in my life. As you know. When you see things that we promote. I don't say that often. But we're not cherry picking ideas here. I mean, these are massive gains that you could see in crypto. Wall Street's not covering this. These are names that you can get in early during the very early stage. At $10 million, $20 million, $30 million valuations. And if they work out, they become the Solanas, Cardanos, all these, Avalanche. All these great names. Again, names that we have in portfolio that we're doing incredibly well on. They show you how to find those ideas. So the event, Crypto 2024, it's going to be at 7 p.m. It's going to be Thursday, next Thursday. So not tomorrow, but next Thursday. Okay, so to register, absolutely for free, go to CurzioCrypto.com. Again, live event. It's not going to be like a 45-minute thing. I'm probably going to talk about 15 minutes of some of the stuff I'm talking about and show you how it's not just Bitcoin. Because there's people that are just religiously tied to Bitcoin. That's fine. It should be part of your portfolio like a Microsoft or an Apple's part of your portfolio. It doesn't mean you don't own small caps. You should have exposure to risk. And when you're buying risk, it's about risk reward. Something I've done all my life within small caps. And when you look at the potential reward of the risk that you're taking, you have to have exposure to crypto. A little exposure. You could lose money. Of course you can. But the amount of money you could make could be life-changing. It allowed me to buy a brand new house and build my first ever house in a great neighborhood in Jacksonville. And these are the gains that crypto could offer you that you can't find every place else. So again, register for this event. It's free. Go to CurrzioCrypto.com. And next Thursday, which is February 8th at 7 p.m. So first 15 minutes, provide charts, talk a little bit, and then it's going to be a Q&A. Ask me whatever you want. It'll be a lot of fun. We had a lot of fun last time, and I couldn't believe, again, how many people stayed on. I said, all right, fine. I was just hanging out. I'm probably going to have beers with me this time. Just drink beers and answer questions and talk and have fun, right? That's what you want. You want to be a fun event, cool event, educational. You guys learning about crypto and understanding why you need to be in this, and nobody's really talking about crypto coming back. Why? Because we have these big earnings coming, and we have the Fed coming out today, which everyone's saying is not a big deal, which I said wouldn't be a big deal in December, and look what happened. It's the pivot. Now they walk back to pivot, back and forth, all this bullshit. But in the middle of this, crypto is just catching a bid, and it makes sense going into the halving, and it's going to make sense long after that. With the amount of money coming into ETFs, you have to have exposure to the sector. It's real, and have exposure to the right cryptos. Not just any bullshit ones or garbage. That's my job, to really dig through and find out the best names for you. And I'm going to teach you how to do that. How to get exposure, what platforms to use, how to stay safe. Everybody's worried about crypto and money getting stolen and stuff like that. That's why you see all these stories being highlighted. I think I read a stat, like less than 0.4% of all transactions were legal in all of crypto. You don't hear that stuff, right? The government doesn't want you to hear that stuff. They want to shut this shit down because it impacts the very industry that they protect, which is the financial industry and the banks. That's why Jamie Dimon hates this industry so much. Elizabeth Warren talks terrible about it. Most politicians hate it because they get lots of money from the banking industry and it provides them control. This is the only industry in finance, right? If you look at all the industries across the board, guys, if you look at the banking sector, it's the only sector where you can't start a company and become one of the largest in the world, like Tesla did with autos. You can go throughout all industries. Meta became one of the largest companies in the world. NVIDIA just surpassed Intel and everybody else, to become the best chip maker in the world and the greatest. You can't do that in banking. They don't allow it. They just don't allow it based on the capital ratios. So no matter how great you do in banking, you're not allowed to get into that top four. It's a boys' club. So when every bank fails, they take the assets, the Fed backs them, and they give them JP Morgan for free. And then JP Morgan fires all his employees. That's why it's trading at an all-time high. Again, a lot of bullshit. Crypto disrupts that entire industry, which is by far, forget about technology, finance, by far the most powerful industry in the world. So next Thursday, February 8th, 7 p.m. if you're interested. Again, you can register by going to CurzioCrypto.com. So that's it for me. Questions, comments, email me, frank@CurzioResearch.com. And I'll see you guys tomorrow on Wall Street Unplugged Premium. Take care. Love this episode of Wall Street Unplugged? I think you'll really love Wall Street Unplugged Premium. The Wall Street Unplugged Premium is my members-only podcast where I dive even deeper into this week's events. Well, I'll do even more than tell you what's moving these markets. I'll tell you specifically what moves you can make today. So this is going to be about trading. Put big money in your pocket right away due to the inconsistencies I see daily in the market. I'm talking about specific investment ideas I'm recommending and tracking each week that I believe will be impacted directly by everything I just talked about today. Plus, you're going to get the chance to go even further down the rabbit hole with me and my co-host, who's Daniel Creech, as we discuss which of these week's trends could turn into massive windfalls. Including the big trends that we see lurking on the horizon, also the news we're picking up from our network of insiders, which has gotten bigger and bigger thanks to you and so many people listening to this podcast in over 100 countries. And you get a chance to talk to me directly in my special Ask Me Anything Q&A session. All of that and a lot more, like premium interviews with world leaders in finance, technology, industry, and politics. This is all part of Wall Street Unplugged Premium. And becoming a member is super simple and super cheap. So head on over to WSUoffer.com to check it all out. Sign up today, and you won't miss a thing. That's WSUoffer.com.
Wall Street Unplugged is produced by Curzio Research, one of the most respected financial media companies in the industry. The information presented on Wall Street Unplugged is the opinion of its host and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.